Hi guys, this is Tim Melvin of the Tim Melvin Deep Value and Banking on Profits Report, and I guess this is take 2 of this week's video. We tried to fix some sound problems and settings. And the first time we ran through this, and the sound would have been perfect if there had been any. So we'll do the video a second time real quick. Listen, it's a great day to be a community bank stock investor. We had 2 takeovers today. I'm going to look at them separately because the first one I want to talk to you about was up in Baltimore. It was Fraternity Federal Savings Bank. You may remember several months back I mentioned that Joseph Stillwell was accumulating positions in a lot of banks in the Baltimore area, and I kind of wondered what he was up to. Baltimore's not a ragingly attractive market for commerce at this point in time. I like the suburban areas as you head out down towards Annapolis and D.C. Baltimore itself is not all that exciting, but he bought 3 banks in Baltimore, and almost immediately the first bank, Hamilton Bancorp, bought Fairmont Bancorp, and we did rather well on that transaction. Now, today, Hamilton Bancorp has come back and they bought the third bank. So they bought out Fraternity Federal Savings and Loan. Now, this transaction was actually done at a tiny discount to book value. And this immediately set up the question of, oh my goodness, now everybody knows these banks have to sell. Is the opportunity going to disappear now because we've got all these people that have to sell, so nobody's going to pay a premium? This is horrible news. By the way, we made about 25% on the transaction in about a year, and that's a horrible result I'll take year in and year out. But in fact, don't read anything into this. But book value premiums for deals are about 1.35. They're going to stay there as the economy gets a little better. If and when the economy gets a little better, we'll see that premium start to move a little bit higher. But for now, 130 to 1.35 is about the rate, and I'm real comfortable with that because we're buying generally between 85, 90%, and even lower as a multiple of book value. I think our average in the portfolio buy list right now is about 82%. So I'll take 1.35 all day long. But 1.35 is an average. Okay, you've got some banks that are getting paid more. These tend to be the banks that are better performing banks. ROEs well over 5, ROAs well over 1. Nice solid loan portfolios, very attractive branch networks. That doesn't describe Fraternity Federal Savings at all. There was one, maybe 2 banks that might be interested in Fraternity and in the little branch network of 4 branches and 162 million of assets there in Baltimore. And Hamilton had already bought one of the 2 that I thought might possibly be interested in it. They only earn an ROE of 2%. The return on assets is 0.2. They've got a lot of excess capital. They just can't earn anything on it in a very competitive, economically weak region like Baltimore. So not a lot of potential buyers for this. Wasn't going to be a bidding war. But with these underperforming banks, remember, the trick to us making money in bank stocks, particularly true of those that are underperforming, is paying close attention to the price we pay. When we saw Mr. Stillwell file a 13D on this bank, we noted that it was extremely cheap. It was a poor performing bank, but we could get it for 73% of book value. So if it only goes out at book value, which is pretty much what happened, still make a really nice return on the assets. Now, what's really interesting is Hamilton is, free stock pick, here we go, is also on our buy list, and they now have turned themselves into a significant competitor in the Baltimore market with these last 2 acquisitions that they've done in the past year. So Mr. Stillwell is still a large shareholder, and I guess when he takes the merger shares in from Fairmont and now from Fraternity, he's an even larger shareholder. Haven't seen any indication that he sold, so I assume that he has kept all the shares that he has acquired. So this is going to make Hamilton a pretty interesting little bank, in my opinion, especially since it's very cheap on a price-to-book value basis. So, but it's an underperforming, very poorly performing bank with too much capital. They can't do anything worth about book value. Okay, now let's look at the second transaction that happened today. Now, this one, and we'll tell you, it wasn't in the portfolio. I originally bought it back in 2013, wrote about it on realmoney.com, but by the time we bought the newsletter out in 2014, it was already above book value, so it was never really a candidate for the portfolio. But Yadkin Financial today bought out Newbridge Bancorp down there in Charlotte, North Carolina. That's one of those markets I've told you several times over. There's a lot of people looking to make acquisitions in the North and South Carolina market. It's a good idea to be looking at these Carolina banks, finding those that fit our parameters, and we're going to be doing some of that over the weekend coming up here, digging into the Carolina banks, because I think there's a few more bargains that we might want to add. We've already got a ton in North Carolina. Sorry about that, but we want to look a little deeper into the South Carolina markets. But anyway, they paid 1.6 times tangible book value because Newbridge is earning an 8% return on equity and a 0.9 return on assets, which is right, kind of around in the industry average. So doing a much better job than, say, the guys up there at Fraternity Federal Savings and Loan. They're a higher performing bank, extraordinarily attractive marketplace in and around Charlotte, North Carolina, with a fantastic branch network and a lot of cost savings that can be pulled out of this transaction. So it made sense to pay up, and they did. So if you add 1.6 times and then the 1 times that Fraternity got, and you divide it by the 2 deals, where you've got 1.3, and that's how you get to 1.3. The lower performing banks, they're going to get a lower multiple. Better performing banks, a higher multiple. We own lots of both. We should come out just around the 1.35 times mark. But anyway, that makes 3 in 3 weeks for portfolio bank takeovers. 4 for me personally, because I had the old position in Newbridge from years ago. But we'll just count 8 takeovers year to date. So that's fantastic. I actually think it's been real strong in the last few weeks. I think people are going to look to get deals on the table before the end of the year. So I think we'll see a lot more deals as we move into the end of the year. This opportunity's not going away anytime soon. There's still plenty of banks. There's still between 6,000 and 7,000 banks in the United States. Most of the folks I talk to say that over the next 10 to 20 years, that's going down by half or more once again. The regulatory costs, and anybody that thinks regulatory costs are going down over time has not studied the history of the federal government. The costs will be going higher, not lower, over time. So you'll see more banking regulations added in the future. It's just going to be very difficult to be, $1 billion in assets or less bank. So all those are subject to takeover offers unless they make deals of their own that sufficiently grow the bank and allow them to compete. Either outcome is a pretty good deal for us as investors who paid a very low price to book value for the stock, however that turns out. And keep something in mind, guys. Yeah, everybody knows these banks need to sell, but you're forgetting one critical factor. For every bank that needs to sell, there's probably 5 that need to buy. There's no organic bank growth in this economy to speak of. In order to grow their assets, earnings, and book value, banks are going to need to make acquisitions. When you have a 2% GDP environment and the actual income numbers and wages being paid are very stagnant, not a ton of loan demand out there. Some commercial real estate demand, some of the banks, that's where they're seeing their growth. But we're not going to have this environment where you can grow organically and experience great earnings, loan, and asset growth by raising fees on your products or earning higher interest rate spreads. It's not going to happen for some time. The path to growth is acquisitions. So for every seller, there's probably 3 or 4 buyers, and when you have that type of environment, you get a little competitive bidding. Look at the Yadkin Newbridge deal. The CEOs knew each other. They, had drinks and dinner at the various banking conferences over the years there in North Carolina. They, had a friendly relationship. Newbridge had been thinking about selling. Yadkin, of course, has been a consistent and excellent acquirer over the last several years. And eventually they got together and they realized the cultures of the bank matched. There was a fantastic overlap in the branch network. There was a lot of cost that could be taken out of it. And the banks were just a good fit for each other. And the deal got done. Going to be a lot more of that as long as we are conscious of the price that we pay for our community banks. And we try to make sure that we have at least one activist or bank stock specialist in the deal with us. We're going to do very, very well for many, many years still to come. Anyway, we were talking about consolidation trades, just kind of sitting around kicking stuff around the other day. And your stock back as a value investor, you tend to get into industries that are sort of in a state of disruption. That's why the stocks are cheap. There's a lot going on. And particularly it has been things like where regulatory pressures were increasing and it was causing problems. And you look at the airlines, the utilities, the hospitals over the years that have consolidated. And when you bought in at the bottom of those trends, when these things were trading with low enterprise value to EBIT ratios or low price to book values, you ended up making a lot of money when this consolidation trend came through the industry. Radios and TVs in the 80s and 90s that was almost as much fun as the bank, because it seemed like there was a deal a day there for a little while as everybody went to consolidate these radio and TV station empires. We've seen it in health insurance, particularly since Obamacare. I think that one's about done. The big money might have been made there. I only count 18 health insurance organizations left publicly traded in the United States. So I'm not sure how much more activity we can have in the health plan providers, but that's certainly going on. Hospital consolidation continues to go on. And there's a couple other trends in addition to the mega trend of community banks that we think will be in place for a long, long time. Keith Bratton Woods, excellent research and trading firm for financial stocks, I've written several pieces lately on the consolidation trend in the property and casualty industry, and the reasons are not dissimilar to what's going on in the banking industry. First, lots more regulations to deal with in the aftermath of the financial crisis. They threw those rules at everybody. And then it's very difficult. Insurance is, it's an underwriting business and investing business. On the underwriting side, the more data and information you have, the better you're going to do. Well, data and information costs money. So the great big companies like Allstate, they've got lots of it. And they've got the talent and the skill, and they can pay to have the people crunch these numbers and do just a little bit better on that rate making and underwriting side than their smaller competitors. But that little bit better is huge in a competitive marketplace like insurance. Just for reasons of scale, a lot of these insurance companies are going to need to look for larger merger partners. Now, I'm doing some digging on that. I think I'm a little late to the party in this one. I'm not finding the number of insurance companies trading below book value that I might have a year or two ago. But we're going to dig through it because I think they're right. I think that this is going to happen. There's a ton of little property and casualty insurance companies around the country, and I'm not sure what their survivability rate on a standalone basis is. So we're going to look into that. And then over 2 weeks ago, I think it was, maybe it was even just last week. Time runs on. Green Street, advisors wrote an excellent article about what they thought would be takeouts, basically, in the REIT space, because the shares of the REITs are trading for less than the actual values of the property. So some of the private equity funds and real estate funds could come in, buy the REIT, pull the property out, and have a gain. So that was an interesting thought, but you put that together with what Sam Zell has been saying. Zell says that the smaller REITs, they can't compete, and they are trading at pretty good discounts to the value of their properties in many cases. It's going to make sense for them to seek merger partners from larger REITs, because otherwise they're going to be pushed into liquidation mode. They do not have the access to financing, to the capital markets, or their strong relationships with people in the commercial real estate space that the larger REITs have. Again, it's a matter of scale. Now, this one's going to go on for a few years. There's not a lot of listed REITs, believe it or not, but there are several. I believe Mr. Zell called it $2 billion or less of stuff. That below that level, they're probably going to need to look for a merger partner. And I think that could be an interesting consolidation wave that gives us an opportunity to make money, because we did identify some that were trading at what we thought to be substantial discounts to asset value. So we're going to add that to our little arsenal of value investing tools and see if we can't make some money in the real estate space as well. Now, the next big consolidation trend is going to be an industry. But first, the oil industry, the oil and energy, the exploration production companies, the drilling companies, and the oil services companies. First, we have to have the financial wipeout. As the hedges that were put in place the last few years begin to roll off here over the next 6 months or so for the U.S. Exploration and production companies in particular, we're going to see who can survive and who can't. When those companies start to go, of course, that's going to impact the drillers and the services companies. And we'll get a bunch of bankruptcies, I'm pretty sure of that. And we'll see exactly what the industry landscape actually looks like. And then we'll see, I think, a very large consolidation wave among smaller oil and energy-related companies. We've got our eye on several, but at this point, we're completely willing to sit back with the energy stocks that we own. We're not anxious to run in and buy more at this point in time. We don't want to sell what we have. We're going to stand pat. Now, I do have a couple of book recommendations for you. I haven't done this as much as I used to in the past, but if you're a serious baseball aficionado, you need to go download on your Kindle or order the book itself, Pitch by Pitch by Bob Gibson. The legendary Cardinals pitcher takes you pitch by pitch through his thought process, his strategy, and his approach to every pitch in the first game of the 1968 World Series, where he set the record, surpassing Sandy Koufax for most strikeouts in a World Series game. If I'm not mistaken, he threw 17. Which is remarkable when you're playing a team that was as loaded as the 1968 Detroit Tigers. Fascinating book. It's for baseball's, hardcore fans, because otherwise you're just not going to like it. So there's some other anecdotes about the players and everything thrown in, but mostly it's a pitch-by-pitch examination of a very fantastic and exciting ball game if you like pitchers, Jules, because Denny McLain was the starting pitcher on the other side of the mound, last man to win 30 games, and did that in 1968. Next up, if you're a little bit twisted and demented, the new Christopher Moore book, Secondhand Souls, is out. I read it. I laughed my head off. The only thing I can say is it's as demented and twisted as everything else he's ever written. If you're a Christopher Moore fan and used to his work, go buy it. Now, if you're not, you need to go back, start with books like Coyote Blue, some of his other Sequin Love None, some of his earlier books, and kind of work your way forward so you learn to appreciate the twisted nature that is Christopher Moore and his books, but they are well written and hysterical. So, and the last book, and this is just for fun, Sunday afternoon. I'm not doing anything reading. Ed Robinson has written a series of books called the Trawler Trash series, featuring the adventures of one Meade Breeze. It's just a good, fun read as this guy bops around the Caribbean and the Keys at 6 knots an hour, which of course is about all one of those larger trawlers does. Great book, great stories, mind relaxing, and just fun to read. So anyway, that's all I've got for you here today. My son and his friend are on his way over. We're all going to head out to dinner. Then we've got, of course, the debates and some baseball later on tonight. So it should be a pretty pleasant evening. This is Tim Melvin coming to you from down here in Central Florida. Thanks for watching.